So in this video, we will diversify the portfolio by assigning equal weights to all the considered assets. So the goal of this video will be to show how to create 1 by n portfolio of the list of companies. So when I say the list of companies, these are the random company names, or let's say the stock names that I have taken. But let me tell you, these are like very random, and I just took this list from another video, and I really don't know how does these stocks works, or let's say performs. So these stocks were like taken very randomly. So what we will be doing after taking these stocks, we will calculate the returns and then use the quant stats library to quickly obtain all the relevant portfolio evaluation metrics in the form of tier sheet. So I will show you the tier sheet, what it is and what all information that we can get from the tier sheet. So a sheet is a concise, or let's say a one-page document summarizing the important information about a public company, or let's say the listed companies in a stock exchange. So let's do this. So first let me clear all the output. So this is the overall syntax. It's very straightforward, but it does give a lot of information. So let's go through it one by one, and then I will show you the tier sheet. Okay. So how does it work? So we have imported all these libraries. So we have to use the Yahoo Finance to take the download the data from Yahoo Finance portal, or let's say with the help of an API, and then quant stats is another library that we will need so that we can create the tier sheet. Then these are the list of assets that I mentioned, and this is how we download the data from Yahoo Finance. So let me just run it and then run it. So if you would like to see the data, maybe I can show it to you. So let me run this one as well. So this is how we got the data. We have adjusted close, open, and yeah, so all these columns are respective of the data or the date range that we selected. And then we created the returns based on the adjusted close column. So this is the adjusted close column for all these stocks. And then we have created the percentage change and a dropped not available data. Now the next most important thing is portfolio weight. So what we have done, so since we have five stocks or equities, so we have distributed the weights equally. And then let me run this one as well. Let me show you the returns. So these are the returns, and after that, like I mentioned, we have created the portfolio weights, and then again maybe I can show you the portfolio weight, but it will be like each portfolio or each stock has given equal weight of 0.2, or let's say the 20%. Now we are creating the portfolio return. So portfolio return, what it is doing, we have created a matrix of multiplication, also known as the dot product of the portfolio weights, and then we have done the transpose matrix of the assets return, and we have created the series object with the help of pd.series. So let's run this, and then maybe I can show you the data as well. So this is the data. These are the portfolio returns based on the specific date. Now let's create the snapshot, or let's say the figure containing the basic portfolio evaluation plots using the quant stats like I mentioned earlier. So let me run this, and this is we got the cumulative return, drawdown, and daily return. So I'll just brief what it is. So cumulative returns plot it represents the evaluation of the portfolio's worth over the time period. So it's a cumulative return. So if there is a, let's say, the calculation is done on the cumulative basis, not on like the each day basis. So it's like the overall performance of the return, or let's say the portfolio. And then this is the underwater plot. We also call it underwater plot. So this plot represents the investment from a pessimistic point of view, as it also focuses on the losses. So it plots all the drawdown periods and how long they lasted. So see, if you see, this is a drawdown, and then till here it's a drawdown. So it shows how long these period of losses lasted. So from here till here it was a drawdown. Now lastly, we generated the evaluation matrix. So let me run this one as well. So this is the evaluation matrix. So we are benchmarking the National Stock Exchange of India as a benchmark. We could have also done it's like some other, even the equity, or let's say a ticker, but I thought it's better to compare it with index itself and then pass this portfolio return on to this syntax. So let's see what it is doing. So this is the start period, which is 23rd, let's say the June, January, March, April, May, June, from June 2nd, 2023 to 27 of 2024. Now let's talk about a couple of most important topics, or let's say the points one is the cumulative return like we discussed. So the stock exchange gave somewhere around 30%, but our strategy gave 36%, 36.5%, which is really good. The CAGR is 18, but our strategy gave 22, which is again good. Now what is Sharpe ratio? So Sharpe ratio is widely used metric for evaluating the risk adjusted return, let's say often investment, or let's say the portfolio. It measures the excess return, or let's say the return above the risk free rate per unit. Or I'll give you a brief what is the Sharpe ratio. So the higher the Sharpe ratio, the Sharpe ratio, if the Sharpe ratio is higher, it means it has a better risk adjusted performance. It also quantifies how much excess return you receive for, let's say, additional volatility, let's say the risk of holding that particular stock. So if, let's say, the risk is higher, then your Sharpe ratio will also be higher. So if you see over here, the Sharpe ratio is 2.05 for the index, and for our portfolio it's 2.23, which is really good. And similar is for the Sortino ratio as well. So it provides a measure of risk adjusted return that considers only the downside risk. Then we have some Omega. So again, I think Omega is almost the same. So Omega incorporates the entire distribution of the returns and not just the mean or the variance, which is again good. And max drawdown, we spoke earlier, so max drawdown is -6, and then for our strategy of the portfolio is -8. And the longest drawdown days was 74 for the index, but for our strategy it was 122, which is not good. And maybe last but not the least, so just to give a more detail about this, it provides insight into a maximum loss investor can or could have experienced if they had invested at the peak and sold at the bottom or something, right? So if I say as a summary, the Sharpe ratio is the measure. Sharpe ratio measures the risk adjusted return, which is in which the higher is better. And then Sortino ratio is focused on the downside risk. Higher is better for volatile assets. Let's say when you take more risk, when the stock is more volatile, it gives you more performance or better performance. So yeah, this is all. So what you can do with this is to compare your portfolio with the index, and then you can see which one is performing better. One of the things which you could have done over here, you can compare it with, since I have taken only 5, you could have done more lists of stocks and then compared it with more other options, or let's say the equities. This is what you can play around with, and then you can check which portfolio gives you a better return when compared to the index fund. So this is all. Thank you so much. Have a great day. Please make sure to like, share, and subscribe if you like this video. Eat healthy and drink plenty of water. Till then, take care. Bye. Have a great day.